Hello and welcome to episode 27 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria and I currently attend the University of California, Los Angeles.
What we will cover on the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as a merger arbitrage tool, check out insidearbitrage.com.
On today's podcast, we'll discuss Concentra Biosciences swooping in again to buy yet another cash-rich zombie biotech company, the Italian chocolate maker Ferrero acquiring the breakfast cereal company WK Kellogg, Kraft Heinz deciding to split itself up by spinning off its grocery business, CoreWeave finally deciding to acquire Core Scientific after on-again, off-again rumors that a deal was likely, a large buyback at a fintech platform provider, the Bancorp, a new CEO announcement at Baxter that caught our attention because of his long stint at Danaher, and so much more.
We are once again going to start this episode with announced mergers and acquisitions. The core story of our podcast is the acquisition of Core Scientific by CoreWeave in an all-stock deal valued at $9 billion. There were several unusual things about this acquisition. So, for example, rumors of the potential deal surfaced more than 10 days before the actual deal was announced, and Core Scientific saw its stock run up from a little over $12 per share to $18 per share. There were actually expectations among traders that the deal price could be as high as $30 per share.
Instead, Core Scientific saw its stock price drop after the deal was announced last Monday and closed trading at just under $15 per share. Both Core Scientific and CoreWeave continued dropping, and at one point, the spread on the deal increased to over 40%. The spread then compressed a bit, and there's still a spread of over 24% on this deal. Before we get into why the spread is so large and what caused the stocks of both companies to drop so sharply, let's explore what both of these companies do.
Before I get into what both Core Scientific and CoreWeave do, it's worth mentioning that such a large spread is something I've only seen once before in an all-stock deal, where the company Chicken Soup for the Soul Entertainment was trying to buy Redbox, the DVD rental company. And the spread on that was very, very high because you couldn't short the acquiring company. Getting back to this deal, Core Scientific is a data center company that focuses on high-performance computing related to AI and Bitcoin mining. Core Scientific went public by merging with a SPAC in 2022, and as is usually the case, promptly saw its stock drop precipitously into penny stock territory. So it was just worth a few pennies at one point. It then went on to go up more than tenfold in the last 2 years as speculative mania returned to the markets.
Despite revenue declining for the fourth sequential quarter and down 56% year over year in Q1 2025, the company reported a massive net income of $581 million, or $1.25 per share. This was primarily driven by mark-to-market adjustments related to warrants and contingent value rights, because the stock had dropped majorly in Q1 and lost nearly half of its value. The company was also on track to deliver 250 megawatts of billable capacity to CoreWeave by the end of 2025, which is where CoreWeave enters the picture.
CoreWeave runs a cloud platform that provides access to infrastructure and specifically NVIDIA's highest-end GPUs. The company has benefited from a close relationship with NVIDIA, which gives it access to the latest line of NVIDIA GPUs, and as is often the case these days, NVIDIA also has a significant equity stake in CoreWeave. As a result, companies like Microsoft have leaned on CoreWeave for their GPU infrastructure needs, and Microsoft accounted for a whopping 62% of CoreWeave's revenue last year, which amounted to about $1.2 billion.
CoreWeave went public in April of this year, and the stock is already up more than 200% in the last 3 months. The announcement of this Core Scientific acquisition should not have been a big shock to investors of both companies, Because not only was a rumor out for more than 10 days before the actual announcement, there was a rumor of a potential deal going as far back as June 2024.
Yeah, looking at that 200% run up in the stock price, it almost reminds me of the dot-com bubble days where things would run up on day one by 100, 200% or more. Given the run up in both companies' stocks, the possibility of a pullback was high, and this merger announcement triggered it, especially because core scientific traders who were expecting a high price were disappointed. CoreWeave investors were also likely disappointed because Core Scientific's revenue has been declining and the mark-to-market profits from Q1 will likely reverse in Q2 2025. When I looked at this company and I saw the declining revenue but the massive profit they announced in Q1 2025, I was just absolutely shocked and had to dig in deeper to understand how the company could report that profit. And at the end of the day, it was the mark-to-market gains that they had.
Getting to the large spread on this deal, considering the low float of CoreWeave and the high borrow costs, shorting the stock of CoreWeave in order to capture the spread on the deal wasn't really an option.
I was discussing a potential synthetic options trade with a couple of arbitrageurs over the last few days and have elaborated on it in our latest Merger Arbitrage Mondays article.
Last episode, we talked a lot about Concentra Biosciences, an investment vehicle owned by Tang Capital Partners that has gone on a bit of a biotech buying spree over the last few months. The company seems to be focused on acquiring zombie biotechs, biotech companies that trade below the cash on their balance sheet with the goal of returning or releasing that capital. In our last episode, we noted that Concentra seemed to announce a new acquisition every single month, but it looks like they broke that pattern this week with announcing another acquisition.
Well, it helps that, there's money to be swept up by acquiring these cash-rich biotechs, and Concentra Biosciences is now set to acquire Cargo Therapeutics for $4.38 per share in a deal valued at almost $171 million. Just like the IGM Biosciences deal we discussed last week, Concentra has also included a contingent value right, or CVR, that represents the right to receive 100% of the closing net cash of Cargo over $217.5 million and 80% of any net proceeds received within 2 years following closing from any disposition of certain Cargo's product candidates that occur within 2 years following closing.
Again, this CVR is not tied to the performance of any potential therapies in Cargo's pipeline, nor is it based on the drugs reaching any specific milestone, as is typical of most CVRs. Instead, the CVR is just a way to distribute excess cash.
Cargo Therapeutics has a market cap of $214 million and has about $288 million of net cash on the balance sheet. So for it to be acquired for only $171 million is fascinating. The stock trades at $4.59. So it looks like the market is valuing the CVR at just about 20 cents. We do have to keep in mind that most of these biotech companies, even though they might not be focusing on a viable product at this point, might still be burning a lot of cash. So if it takes a quarter or two for some of these transactions to take place, you end up with less cash on the balance sheet.
Moving away from biotechs, gold has been an amazing asset class over the last few years, and has nearly doubled in price over the last 3 years. The shocking thing is that over a 5-year or 10-year period, gold has performed almost as well as the S&P 500, and during the April drop in markets earlier this year, gold was outperforming the S&P 500 over both a 5-year and 10-year period. The even more impressive thing is that gold did so with significantly lower volatility.
Switching back to talking about investors in gold mining stock, they haven't been rewarded quite as richly as those of the physical metal unless you picked a company like Gold Fields. If there is a lag in the mining companies catching up to the price of physical gold, then we should see some of these mining companies start to do better over time. But the culprit is often rising mining costs and depleting mines. In this environment, we have been seeing some consolidation in this industry, including a large acquisition that was announced last week.
Sandstorm Gold decided to merge with Royal Gold in an all-stock transaction that has a closing value of $3.5 billion. The spread on the deal is small at less than 2%, but it'll be worth watching some of the minor gold mining companies to see if we see any further consolidation.
Some of these gold companies also mine copper. Freeport McMoRan comes to mind. And the big jump in copper prices due to newly introduced tariffs by the Trump administration could also help these companies depending on where they are mining the copper. So if they are mining the copper outside the US, which is usually the case, they might not benefit quite as much.
A fourth new deal this week that is worth discussing is the acquisition of Verona Pharma by Merck in a $10 billion all-cash deal. Unlike most biotech and pharma deals these days, this one does not have a CVR attached to it and also has a longer than expected timeline close. Merck and Verona expect the deal to close by the end of this year.
Verona, which is based in the United Kingdom, focuses on respiratory diseases, and in June 2024, the FDA approved its drug for the treatment of chronic obstructive pulmonary disease. Its small molecule, and I'm going to butcher this name, ensifentrine, is also in phase 2 trials for non-cystic fibrosis and asthma.
2 episodes ago, we discussed the FTC approval of the acquisition of the food products company Kellanova by the candy, pet food, and other food products company Mars in a nearly $36 billion deal. Despite the FTC approval, though, the deal is still facing regulatory scrutiny from the European Commission, which has pushed back the expected closing date of the deal from the first half of this year to the second half of the year.
I wonder what the European Commission is going to say when they see that the Italian chocolate company Ferrero Group has decided to acquire the breakfast cereal company WK Kellogg. The Ferrero Group, known for brands like Nutella that you like a lot, Tic Tac, and Ferrero chocolates, which I like a lot, for a closing value of $3.1 billion. Under the terms of the agreement, Ferrero will acquire all outstanding equity of WK Kellogg for $23 per share in cash.
It's fascinating to see further consolidation within its broader food products industry. But what's even more interesting is that WK Kellogg was actually spun out of Kellanova in October 2023. The Kellogg company split into 2 parts: Kellanova, which kept most of the food brand, and then WK Kellogg, which retained the North American cereal business.
As expected, the spin-off dropped sharply following the separation, losing nearly half of its value, but then rallied to highs of over $34 per share before settling down somewhere in the $15 to $20 range. The stock skyrocketed by 37% since the announcement of the deal, and thus the spread of the deal is just less than 1%.
Switching gears to deals in the works, there was a report by Bloomberg that the Apollo Global-backed studio, Legendary Entertainment, that is behind movies like Dune and Jurassic Park, approached Lionsgate Studios after its separation from the old Lionsgate Entertainment that is now known as Starz. The stock moved up nearly 20% to $7 per share on this news.
We have been writing about Lionsgate for more than 2 years, and our thesis was that the value of the movie studio would make it an attractive acquisition candidate. We have also reported on insider purchase of the company by former Treasury Secretary Steve Mnuchin, both on this podcast and in our Insider Beacons articles numerous times. Following this news, hopefully other interested parties might also act and deliver some good news to Lionsgate investors who've been very patient for a number of years.
That's true. I've been writing about Lionsgate for close to 2 years at this point. I felt like once or twice every single year we'd write a new report on Lionsgate. But you've actually been looking at the company since 2013, right? Shortly after the release of The Hunger Games. I remember one of your first articles about Lionsgate was over a decade ago.
Even before that, I think the first time I invested in the company was probably 2007, 2008. So I've been interested in the company for a long time. I haven't held the company for 18 years, if you're thinking that. I had bought it once before in 2007-8, sold it, but I've held it for the last 2 or 3 years at this point.
Moving on to other deals in the works, there was also a report by Bloomberg that Autodesk is considering taking over the rival software company PTC. After an initial spike, PTC stock dropped the next 2 days, reflecting the market's skepticism that Autodesk might want to make such a large acquisition.
Yeah, PTC's enterprise value is nearly $25 billion compared to Autodesk's enterprise value of about $61 billion. Even if a deal were to materialize, I would imagine the regulatory scrutiny is going to be high, considering the leading market position for both these companies in the CAD software space.
Transitioning over to our spin-off section of this podcast, it looks like food products companies really seem to be the theme of today's episode. Sources like the Wall Street Journal have been reporting that Kraft Heinz is considering breaking itself up. The packaged foods behemoth was created in the 2015 merger of the Kraft Foods Group and H.J. Heinz, orchestrated by Warren Buffett and the Brazilian PE firm 3G Capital, which we last talked about in the podcast in connection with 3G acquiring Skechers.
In the very episode where we discussed the Skechers deal, we mentioned just how much of a failure the Kraft Heinz merger was. The stock has fallen more than 60% and over $57 billion in market value has been erased due to the higher costs and significant pressures on the value of the company's brands as American consumers began to prefer fresher and less processed foods. I think the other part that also hurt them is because consumers are now opting for grocery store brands rather than the branded consumer food products. And it's hard for these products to advertise as they used to on national TV and reach an audience all at one shot.
Kraft Heinz announced in May that they were exploring strategic transactions to unlock value for shareholders after unsuccessfully trying to sell their underperforming brands like Oscar Mayer and Maxwell House a few years ago to no avail.
According to the Wall Street Journal, the proposed spin-off would separate a large chunk of Kraft Heinz grocery business, including many Kraft products, into a new entity that could be valued at as much as $20 billion on its own, leaving behind the sauces and spreads business like Heinz ketchup. The hope is that the two separate entities would be in total worth more than Kraft Heinz' $32 billion market cap as it stands today.
Continuing on to the buyback section of this podcast, the Bancorp, and that truly is just the name of the company, the Bancorp, not Northwest Bancorp, not New York Bancorp, just the Bancorp, a financial services company that has over $9 billion in assets, just announced a $500 million buyback that represented nearly 18% of the company's market cap at announcement.
Yeah, I was surprised the first time I saw the name of this company as well, the Bancorp. The name of the company is not the only odd thing about this bank. It also operates with no bank branches, and instead of serving customers directly, it provides a platform that fintech companies use to build their products on top of.
This $500 million buyback is a big upgrade to the buyback program, considering that they announced a small $50 million increase to their existing buyback program in 2024 that took their total buyback authorization to $100 million. This is one of those companies that has actually followed through on their buyback announcements, as they have reduced their shares outstanding by 19% over the last 4 years.
And guess what? Over the last 5 years, their stock is up an astounding 633%, and their revenue growth has been very strong. We first came across this company after a string of insider purchases by multiple insiders, and especially in 2024. Back then, I mostly thought of this company as an internet-based bank, and I don't think I fully comprehended that this was a bank that was providing a platform for fintech companies to build on top of it. And I think that realization, had I had it 2 years ago, would have done as well.
As always, hindsight is 2020.
Indeed.
Continuing on to insider transactions, 2 weeks ago, as part of our Insider Weekends article, I highlighted an unusually high volume of sales from insiders across various tech companies, including Michael Dell selling $1.22 billion worth of Dell stock, 6 different insiders of NVIDIA, including Jensen Huang, sell shares, 4 different insiders sell shares of Broadcom, and a few insider sales at Coinbase as well.
The main sale that we chose to feature, though, was Oracle CEO Safra Catz selling $1.56 billion worth of stock. Granted, these shares were sold as a result of exercising options immediately prior to the sale, but to see such volumes of stock being sold is still shocking. I think I still remember seeing Safra Catz when she was at the CFO of the company selling $30 million worth of stock, This must have been 10 or 15 years ago, and being completely shocked that somebody would sell $30 million worth of stock in a week. And here we have a situation where she's selling over $1.5 billion worth of stock in a week, and then continues to sell several $100 million more the following week.
The times change. We did note in that article that the Oracle sales don't necessarily appear to be a negative signal by any means, even though Oracle stock has run up by over 61% in the last year and over 300% in the last 5 years. Suffragettes simply receives so much stock-based compensation and options that some amount of selling is quite normal. However, we were still shocked when we saw an insider purchase at Oracle this week.
Yeah, so the insider purchase was by Rona Fairhead, who's also known as Baroness Fairhead, who made a small $100,000 purchase of Oracle this week. The purchase brought up so many questions, starting with how exactly did a baroness end up on Oracle's board, and why is she purchasing stock now? The last time Baroness Fairhead purchased shares was back in 2021, and she's been on Oracle's board since 2019. So this is not a new director who joins the board and then buys a token amount of shares.
Baroness Fairhead, who is also a member of the UK House of Lords, one of their houses of parliament, most recently served as the Minister of State for Trade and Export Promotion for the United Kingdom Department for International Trade. She was previously the chair of the British Broadcasting Corporation, better known as the BBC, from 2014 to 2017, and then from 2006 to 2013, she was the chair and CEO of the Financial Times Group.
So somebody who's very accomplished for sure. The Financial Times was a division of the educational materials and textbook giant Pearson. Baroness Fairhead had previously served as Pearson's CFO, and her exit package from the company, which is £1 million, as well as £3 million additional pounds worth of stock options, was a large contributing factor in the 2014 Pearson shareholders' revolt.
To see this purchase even after Oracle has run up like crazy is fascinating, especially in light of all other insiders selling. Miss Fairhead last bought shares when Oracle was trading at around $95 per share, less than half of what it's trading at now. To be fair, Oracle only continues to report stellar financial results, steadily increasing the top and bottom line, maintaining strong margins, and somewhat stable free cash flow.
Another insider purchase, which is interesting but not quite as interesting as the Baroness's purchase, was director Brian Healy buying $27,000 worth of Mueller water products. Normally, we wouldn't highlight a purchase so small, but we are in the middle of the quiet period right now. The time every quarter where we see insider purchases slow down as companies begin to implement trading restrictions to prevent any significant buying or selling before earnings are released.
Mueller Water Products does pretty much exactly what the name suggests. The company manufactures and markets products and solutions used in the transmission, distribution, and measurement of water in North America. This includes engineered valves, fire hydrants, leak detection products, pressure management products, and so much more.
We'd normally also skip over such a boring company, but we notice that the company scores an impressive 75 on a IA Quant score, an internal model that we have that ranks different companies based on a variety of factors. And as you already know, sometimes these boring companies actually turn out to be great investments. Mueller Water Products is up a surprising 32% in the last year alone. Definitely not the steady Eddie type of company that you'd expect it to be. And the company also has relatively impressive margins for a manufacturing business of its kind. It generates 34% gross margin and manages to squeeze out 10% net margin from those 34% gross margin.
Mueller Water Products has been growing revenue and net income steadily year over year, with revenue growing nearly 11% last year. And for a company with a $4 billion market cap, the business barely has any net debt on the balance sheet. And as a little cherry on top, Mueller Water Products also pays a small dividend, with a yield of 1.05%. This is why these earnings-related quiet periods can sometimes be a blessing in disguise. The fewer insider transactions can help you discover these niche but great companies that you typically wouldn't come across.
Switching gears to C-suite transitions, A few decades ago, GE was known to be a training ground for management talent, which then went on to join other companies in top roles. The new version appears to be Danaher, which has its Danaher business system, which, like Toyota's Kaizen system, is based on the principle of continuous improvement.
During Larry Culp's tenure as Danaher's CEO from 2000 to 2014, both the revenue and the market cap of the company went up fivefold. He then joined GE to turn around the company through a series of spinoffs, and as a result, GE is up 666%. Kind of an ominous number over the last 5 years.
Surely the devil's number. I think we should sell our GE stock now that it's achieved the 666% return. But this is one of the reasons we pay special attention when someone who is on Danaher's management team joins a new company as a CEO, and especially one that is in sore need of a turnaround. Healthcare products company Baxter, that makes a lot of different products related to dialysis and other conditions, which has been performing poorly for the last 10 years, appointed Andrew Hilder as its new CEO with an effective date of September 3rd, 2025.
During his 8-year tenure at ATS Corporation, the company saw the stock go up 191%. While that is impressive, what really caught our attention was his nearly 10-year tenure at Danaher from 2006 to 2016.
It takes time to turn around a company the size of Baxter, and I expect we will start to see positive impact in year 2 or 3 after Mr. Hilder starts leading the firm. This is certainly one to keep an eye on.
The broadcast television company Sinclair just appointed a new CFO, Narinder Sahai, who comes over from a private company, the golf club operator Arcis Golf. This transition follows an announcement from March of this year, where Sinclair's current CFO stated that she would retire as soon as a successor was found, and a successor was in fact found this month.
Sinclair is a very familiar name for us, especially since earlier this year we saw that the company's executive chairman purchased shares repeatedly. Sinclair reminded us a lot of Grey Television, another broadcast television company that we used to see repeated insider purchases at over the last few years.
Both Sinclair and Grey Television have performed quite poorly over the last 5 years, but both companies are up about 4% over the last year. Relatively uninteresting and flat. But the broadcasting industry as a whole sits in a very unique space at the moment. Historically, broadcasting companies like Sinclair, Grey Television, and Nexstar Media Group would buy up local stations, and consolidation became the name of the game to create a media empire.
With the more hostile M&A environment under the prior administration and the appointment of a new and more lenient FCC chair now, Brendan Carr, who appears to be more favorable towards M&A in general, many experts in the broadcasting industry as a whole are thinking that the broadcasting companies like Sinclair and Grey Television, possibly even Tegna, that have fallen behind in the highly competitive streaming environment, might get a second chance via acquisitions once more.
This week, Apple announced that its longtime COO, Jeff Williams, will be transitioning his role over to Sabi Khan, Apple's Senior Vice President of Operations, later this month as part of a long-planned succession. Mr. Williams will continue reporting to Apple's CEO Tim Cook and overseeing Apple's design team, Apple Watch product, and the company's health initiatives for the rest of the year. The design team will then transition to reporting directly to Mr. Cook after Mr. Williams retires later in the year.
Mr. Williams came over from IBM to join Apple in 1998 as the head of worldwide procurement after being named Vice President of Operations in 2004. In 2007, Mr. Williams played a significant role in Apple's entry into the mobile phone market with the launch of the iPhone, and he's led worldwide operations for the iPod, iPhone, and Apple Watch since that time. He became Apple's COO in 2015, and the stock has risen 745% during his tenure. So a very long track record at Apple, and it looks like he stepped into Tim Cook's role when Tim Cook stepped away and took the role of CEO after Steve Jobs passed.
And Mr. Williams' replacement, Sabi Khan, joined Apple in 1995 as well. And he has served as the SVP of operations for a little over 6 years. So it's nice to see an internal promotion of someone with deep experience at the company rather than a new external hire here.
Yeah, but it feels like in many ways Apple has lost the magic that Steve Jobs created, and it looks like this iterating through the same products instead of coming up with something truly new and visionary.
That's true, but at the same time, it's working. I still see people lining up to get the newest Apple iPhone.
Indeed.
I guess it just becomes a question of how long this will sustain itself for.
Indeed.
And with that, we will wrap up episode 27 of the Special Situations Report. What we covered today, as always, is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of the event-driven world, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on all event-driven activity, as well as access to tools to help you identify opportunities such as the merger arbitrage tool, go ahead and visit insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed on this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.